You could be staring at a company's textbook perfect income statement right now, and it's showing millions of dollars in profit.
Yeah.
But like that exact same company could secretly be a week away from bankruptcy.
Oh, absolutely. I mean, it happens all the time.
Right. And today we're pulling from our business guides on chapter 14 to figure out how that paradox actually happens. Welcome to today's deep dive. We're looking at accounting as, well, the standard financial language of business.
Yeah, we really need to move past just the basic math and see how these documents actually dictate survival.
Exactly. I mean, think of personal finance. A massive salary looks amazing on paper. But if you've got this hidden credit card debt that's quietly draining your accounts, that high income is basically just a mirage.
And that mirage destroys businesses constantly because, profitability does not equal liquidity.
Right.
Like a company can sell $1 million worth of product in a single day, booking this massive profit on their income statement.
Well, $1,000,000.
Wait.
Yeah, but if those clients have, say, 90 days to pay, and the company's own payroll is due tomorrow, well, they are out of business despite being highly profitable.
Man, that is brutal. Which I guess brings us to how we actually track where the money is hiding.
Yep.
And it all ties back to the fundamental physics of accounting, right?
Fundamental physics. I like that.
Yeah, like if I open a coffee shop and I borrow 10 grand from the bank, my cash asset goes up, obviously. But my liability, my debt rises perfectly in tandem.
Exactly. And that equal and opposite reaction operates a lot like a closed-loop plumbing system.
Oh, interesting.
Yeah, it's the mechanical foundation of double-entry bookkeeping. If the pressure or the cash drops in one pipe, it absolutely has to rise perfectly in another. Every single transaction forces a rebalancing.
So this closed loop is basically what drives the entire accounting cycle, like capturing all that raw data so it can be transformed into the three major financial statements.
Spot on. Because that single closed loop can't really tell you how the money is moving or what the overall strategy is. That's why we rely on those big three statements.
Right. And we know the basics. The balance sheet shows what you own versus what you owe on one specific day.
A snapshot, essentially.
Yeah, a snapshot. And then the income statement shows your profit over a period of time. But I feel like the friction between those two is exactly why the statement of cash flows had to be invented.
Well, yeah, the income statement is heavily influenced by accounting methods like depreciation schedules.
Right, which can legally obscure a company's true operational health, right, just by spreading out costs over time.
Exactly. But the statement of cash flows strips away all those theoretical values. It categorizes actual cash moving through operating, investing, and financing activities.
So it forces the company to prove they actually have the physical dollars in the bank to keep the lights on.
Right, regardless of what their profit margins claim.
Okay, so if you were trying to figure out if, say, a local bakery or a global tech giant is a safe investment, you obviously can't just look at raw dollars.
No, definitely not. You convert those numbers into ratios, things like liquidity, profitability, activity, and debt.
Which creates a kind of universal measuring stick, letting you compare companies of totally different scales.
Exactly. Like a current ratio. You divide current assets by current liabilities, and it instantly reveals a company's short-term survival capability.
Whether you're dealing in thousands or billions of dollars.
Right. It standardizes financial health across any industry.
But wait, ratio analysis isn't foolproof, is it? Like, what if a company simply uses a huge chunk of cash to pay off a massive short-term debt the day before the quarter ends?
Ah, window dressing.
Right. Their current ratio suddenly looks artificially amazing. How does a modern analyst or, I don't know, software spot that kind of trickery?
Well, software doesn't just look at the end-of-quarter snapshot anymore. It analyzes continuous, real-time data trends. Cloud computing and data analytics track the historical velocity of cash.
Oh, wow. So the algorithms just instantly flag anomalies.
Exactly, like a sudden, uncharacteristic debt payoff meant purely to inflate a ratio.
That makes sense. And at the heart of all that continuous monitoring is actually our word of the day, the accounting equation.
Yes, assets equal liabilities plus owner's equity.
Right. And the software handles the heavy lifting of keeping that equation balanced in real time, which really shifts the accountant's job from tedious data entry to high-level strategic forecasting.
Yeah, the automation allows analysts to use big data to spot operational trends, manage risk, and predict future performance, rather than just, manually recording the past.
So a business really can look invincible on one measure, but incredibly fragile on another.
Absolutely. To truly protect yourself as an investor or manager, You have to read the friction between the income statement and the cash flow statement.
Using those dynamic ratios to uncover the full story.
Right, you're looking for the complete operational narrative, not just the financial highlights.
Which leaves you with something to ponder. As software and data analytics fully automate the heavy lifting of the accounting cycle and continuously monitor for things like window dressing, will the future accountant need to be less of a mathematician and more of a strategic business psychologist? Thanks for joining us on this deep dive.